Hello friends, welcome to Shriram's. The topic for today's discussion is Global Minimum Corporate Tax. Backstory. Multinational companies have long used creative and legal ways to shrink their tax bills. One of the methods is to artificially shift jurisdiction to tax havens where the tax rates are almost negligible. This move for a global minimum corporate tax, most recently voiced in the United States, is being as an attempt to address that. What is the demand being made in the US right now? The US president is counting on increased corporate tax revenue to fund new spending on infrastructure and social programs. His plan includes raising taxes on US companies and pushing for a 21% minimum levy for US companies' foreign income, which should pressure many countries to raise their current rate. What are the objectives of this minimum tax? The plan is to peg a minimum tax on overseas corporate income that it seeks to potentially make it difficult for corporations to shift their earnings offshore. It will first end the pressures of tax competition and second, end corporate tax base erosion. Why does it matter? A minimum global tax rate could help end a 30-year race to the bottom on corporate tax rates. Why is the need being felt now? Increasingly, income from intangible sources such as drug patents, software, and royalties on intellectual property has migrated to these jurisdictions, allowing companies to avoid paying higher taxes in their traditional home countries. How does it work? For instance, if the US raises its tax rates and imposes higher burden on companies' foreign profits, similar rates globally will prevent them from taking advantage of lower rates overseas. It would also prevent foreign companies from gaining a potential advantage. Who benefits from the current system? Many large corporations do, and some nations benefit by attracting corporations with low rates. For instance, Ireland, with a corporate tax rate of 12.5%, boasts the European headquarters of companies including Google, Facebook, and Apple. How much do the countries lose in tax revenues? The use of tax havens cost governments $500 billion to $600 billion in lost corporate tax revenue each year, according to estimates cited by the International Monetary Fund. How would global minimum tax work? The global minimum tax rate would apply to companies' overseas profits. Therefore, if countries agree on a global minimum, governments could still set whatever local corporate tax rate they want. But if companies pay lower rates in a particular country, their home governments could top up their rates to the agreed minimum rate, eliminating the advantage of shifting profits to a tax haven. Are there any challenges to the proposal? Yes. Global minimum rate would essentially take away a tool that countries use to push policies that suit them. For instance, a lower tax rate is a tool which developing countries can use to push economic activity since they cannot afford large stimulus packages for their population. There is also the challenge of getting all major nations agree on this, since this impinges on the right of the sovereign to decide a nation's tax policy. How will this affect India? In a bid to revive investment activity, in 2019, the Finance Ministry sharply reduced corporate taxes for domestic companies to 22% and for new domestic manufacturing companies to 15%. Although the minimum corporate global tax is likely to remain slightly lower than the minimum corporate taxation regime in India, it remains to be seen if India would join the policy. This is because Indian government is relying on fresh investment to pull the country out of COVID-based recession. Well, that's all for today. I hope you enjoyed today's podcast.